So we are doing the chapter capital budgeting. Please stop talking. We are doing the chapter capital budgeting, in which last class we almost completed the capital budgeting concepts. One more small areas left out, that is base case NPV and then adjusted NPV. Once we complete that, we will now do the next slot called as capital budgeting under uncertainty, where once again number of issues will be discussed, like risk adjusted discount rate, certainty equivalence approach, or real options in capital budgeting, decision tree way of presenting the capital budgeting statements, or Hiller's model, normal distribution, simulation, like that. So many areas which focuses on uncertainty will be discussing in the next slot called as capital budgeting under uncertainty. Again, very simple but an important area from examination viewpoint. In exam they regularly ask either from the leasing or the capital budgeting under uncertainty predominantly. It will take another 2 classes for us to complete the capital budgeting under uncertainty. Today's class, Saturday's class, and to some extent the Sunday class will be taking to complete the capital budgeting under uncertainty. Once over, we will move on to the derivative section. We will be starting with the first chapter called as options. Now, capital budgeting chapter we have been discussing for a long time. If you remember, after I completed portfolio, we have been doing only this chapter, capital budgeting. But without knowing that we are discussing about the capital budgeting chapter, because we divided it into 3 segments, each discussed as an independent unit. Stop talking, please. Settle down, stop talking. So, we divide this into 3 segments. Segment 1, capital budgeting concepts. Segment 2 is leasing concepts. Segment A is capital budgeting under uncertainty. Leasing we completed fully. We are going to complete the capital budgeting concept. So in the capital budgeting concept, that slot, we have planned to discuss the following learning objectives. Number 1 is inflation and capital budgeting, overseas capital budgeting, NPV IRR conflicts, where we discuss life disparity and then timing disparity. One is the concept of EAB or EAC, another is the concept of modified NPV and modified IRR. Then we discuss about the concept of abandonment, where the EAB, EAC will be dispensed with. Then we had capital rationing discussed. Last class we discussed about sensitivity analysis, long-term fund approach versus equity shareholders approach. Incidentally, project IRR, equity IRR was discussed. Only slot that is pending to be discussed is base case NPV and adjusted NPV. Please. Every aspect which we just plan to discuss, we discuss elaborately in depth, whether it is long-term fund or equity shareholders, or whether life disparity, or even modified NPV, modified IRR, about reinvestment rate, assumptions, like that, everything to the core we discuss. These are all interesting as well as unique areas in the chapter capital budgeting. We can say these are all final level areas in this particular chapter. In that, the last slot now we will be discussing is base case NPV and adjusted NPV. Okay. Now, before I go to base case NPV, adjusted NPV, let us discuss long-term fund and equity shareholders approach. Let us summarize that quickly before we just continue that into the base case and adjusted NPV concept. Okay. Now, long-term fund approach versus equity shareholders approach. The entire discussion revolved around the status of the debt provider, right or not? To start a project, we require fund. The fund can be procured from broadly two sources, equity as well as debt. What is the status of the debt provider was the subject matter of discussion in the long-term fund versus equity shareholders approach. Long-term fund approach treats the debt as a co-owner. Equity shareholder approach treats the debt as an outsider. In other words, long-term fund approach can be called as V approach and equity shareholder approach can be called as I approach. Initial investment, operating inflows, discount rate. Above these three only we differentiate. Initial outlay is the amount financed by both in long-term fund approach, how much we are investing, entire cost of project. Equity shareholders approach, how much I am investing, that part of project financed by equity will be written as the outlay. Number 2, operating inflows, how much we are getting is a long-term fund approach. Equity says how much I am getting. And we are getting, when I calculate, I will not reduce the interest and any payment to debt provider because those are all not paid to outsiders, they are paid to the owner. Its status is like an appropriation, I don't know. Now, in equity shareholders approach, from the amount available to us, they reduce the amount paid to interest as well as what the principal repayment, and the balance is the amount available to equity. What I get will be the next issue. Can I see? The interest and principal repayments are treated as outflow as they pay to the outsiders. Next. Third is the discount rate. Our expectation or our cost of capital is WACC. And my cost of capital is KE. Discount using WACC and a long-term fund approach and KE using the equity shareholders approach is in a nutshell what we discussed. Respond yes or no. Generally, capital budgeting exercise is done only as per the long-term fund approach. Most famous way is to discount using WACC, the project cash flows. Nobody finds out NPV using the equity shareholders approach. To some reason, they prefer the long-term fund approach. Suppose in long-term fund approach, they give you profit after tax. They give you what? Profit after tax. Inside PAT, depreciation may be there. We normally what? Add back. Apart from that, while calculating PAT, I'll be having interest reduced or not. Should it be reduced or shouldn't be? Shouldn't be. When I add back, I should be adding back what? Interest into 1 minus t. You should not be adding back the interest fully. For all that the reason has been discussed. I ignore interest means I will also ignore the tax shield on interest. So after that, when you have a cash flow, it is cash flow available to both equity and the debt. When you discount the cash flow using WACC, the cost of equity also has been discounted, the cost of debt also has been discounted. What remains is the money available towards the principal fund providing. If I knock off the initial investment which is the principal, what you get is a surplus which purely belongs to the shareholder, which we call as net present value. Everybody, are you comfortable or not? And when I calculate IRR using long-term fund approach, I call it as project IRR. When I compute IRR using shareholders approach, I call it as equity IRR. Project IRR is a return on capital employed. This is return on equity. Compare project IRR with WACC to accept or reject the project. Compare the equity IRR with the ROE. With the KE to accept or reject the project. So the WACC, the ROCE may be less and ROE may be what? More. The project can give you 18% return, but the shareholder may get what? 27% return. How it is possible? Through financial leverage. We have a relationship between ROE and ROCE. The formula is ROE is equal to ROCE plus debt by equity into ROCE minus KD. That gives you what? The levered effect of the earnings on the project. This is what has been discussed in the previous class. We completed this. Respond. Are you comfortable or not? Did you all revise what has been discussed? Okay, now.